Right now, as we watch the ticker tape in real time, HeartBeam Inc., trading under the symbol BEAT on the Nasdaq, is commanding a live price of roughly 76 cents, marking a massive intraday surge of over 25%. When you see a stock trading under $1 make a move of this magnitude, up more than 25% in a single session, it naturally triggers a storm of notifications across every major trading desk and retail dashboard. Whether you are monitoring this on a professional terminal or checking your Robinhood app while grabbing lunch, this kind of price action demands immediate attention because it signals a violent shift in sentiment. The expectation with microcap stocks in the biotech and medical device sector is often one of extreme fragility. Investors generally expect that when a company faces a regulatory setback, the stock will simply curl up and fade into obscurity. That is the standard playbook. However, the reality we are witnessing today with HeartBeam is a stark contradiction to that fear. The reality is that the market is repricing the company's resilience and its strategic response to recent FDA feedback, effectively betting that the technology is too valuable to be discarded. This tension between the fear of regulatory failure and the greed for a massive technical breakout is what is fueling today's volume, and it is exactly why we need to look closer at what is happening under the hood of this move. To truly understand why HeartBeam is ripping higher today, we have to look past the headline percentage and look at the context of the trade. For the average person engaging in online investing or looking for investment help, a stock trading under $1 might look like a lottery ticket. But if you dig into the order flow, you will see that this isn't just random noise. The volume pouring into BEAT today suggests that traders are acknowledging the company's aggressive pivot regarding its FDA submission. Just recently, the company received a not substantially equivalent determination from the FDA regarding its 12-lead ECG synthesis software. In 99% of cases, that letter is a death knell. It usually means the product is fundamentally flawed or the data is insufficient. This is where the expectation of a crash comes from. However, the company came out swinging with a plan to pursue parallel paths, an appeal and a resubmission. The market is rallying today because the management team didn't fold. They clarified that the FDA's questions are addressable. This effectively puts a floor under the fear, and when you combine that with a low float, you get the explosive upside we are seeing right now. It's a classic scenario where the doom and gloom narrative was priced in too heavily, and now that the reality is slightly less catastrophic than expected, the short sellers are scrambling to cover their positions, fueling a squeeze that rivals the volatility we sometimes see in Tesla stock during earnings season. When you look at the broader online investment landscape, particularly for those utilizing platforms like Schwab Intelligent Portfolios or Fidelity Wealth Management, the focus is usually on stability and long-term compounding. Fidelity ETFs and Fidelity mutual funds are designed to avoid exactly the kind of heart-stopping volatility that HeartBeam is exhibiting today. But for the active trader, utilizing interactive brokers for faster execution or the SoFi Active Investing platform, this is the sweet spot. The discrepancy between the company's market cap and the potential size of its addressable market is startling. HeartBeam isn't just trying to make a slightly better heart monitor, they are attempting to bring hospital-grade diagnostic capability into a credit card-sized device that fits in your wallet. Most people engaged in self-investing are familiar with the Apple Watch or Fitbit. Those devices use a single lead ECG. They are great for detecting simple atrial fibrillation, but they are practically useless for detecting a heart attack or complex arrhythmias that require a 12-lead view. The expectation from the general public is that wearables are just gadgets. The reality HeartBeam is pitching is that their vector-based technology can mathematically reconstruct a full 12-lead ECG from a handheld device. If they pull this off, they aren't just competing with other wearables, they are creating an entirely new category of remote patient monitoring. Let's spend a moment on the technology itself. because this is what justifies the risk for long-term holders. The core innovation here is vector electrocardiography, or VECG. Standard ECGs, the kind you get in a hospital with stickers all over your chest, measure the electrical activity of the heart from 12 different angles. It provides a complete 3D picture of the heart's electrical function. Your smartwatch, by comparison, only looks from one angle. It's like trying to identify a person by looking at their shadow versus looking at a 3D hologram of them. HeartBeam's IMEGO device captures signals in 3 dimensions, X, Y, and Z axes, and then uses proprietary software to synthesize those signals into the 12-lead format that cardiologists are trained to read. This is crucial because a cardiologist cannot legally or ethically diagnose a heart attack, myocardial infarction, from a single-lead watch strip. They need the 12-lead. If HeartBeam's appeal to the FDA is successful and they get this cleared, it opens the door for patients to diagnose a heart attack at home, potentially saving hours of symptom-to-door time. In the world of investment, finding a company with a strong moat is key, and this proprietary conversion of 3B signals to 12-lead data is a massive technical moat. The trading action today also highlights a divide in the investing sites and communities. On one side, you have the fundamental value investors who are looking at the cash burn. Developing medical devices is expensive. There is always the risk of dilution, where the company issues more shares to raise capital, lowering the value of existing shares. This is a standard risk factor you would find in any Fidelity brokerage research report. On the other hand, you have the speculative growth traders who are looking at the intellectual property portfolio. HeartBeam has been ranked extremely high in patent value, right next to giants like GE Healthcare. This suggests that even if the commercial path is rocky, the IP itself has immense value, possibly making them a buyout target. This speculative angle is what drives the frenzy on Robinhood stock trading forums and SoFi Invest chats. The conversation there isn't about quarterly earnings. It's about the binary outcome of FDA approval. If they get it, the stock re-rates significantly higher. If they don't, it struggles. Today's 25% move is the market betting that the yes is back on the table. It is also interesting to compare the sentiment around BEAT to the broader market heavyweights. When you look at Nvidia stock or Apple stock, you are looking at companies that move based on global supply chains and consumer spending power. HeartBeam is decoupled from that. It moves based on regulatory binary events. This makes it a unique, albeit dangerous, diversification tool in an individual brokerage account. It doesn't care about interest rates as much as it cares about the FDA's Office of Cardiovascular Devices. This isolation can be a benefit when the broader market is red, but it also means that you cannot rely on general market tailwinds to save you if the specific company news is bad. For those using Interactive Brokers trading platforms, you might notice the spread between the bid and the ask is wider here than on blue chips, indicating lower liquidity, which exacerbates these sharp moves. Let's pause for a second. I want to hear from you guys. Comment below how many shares of HeartBeam you currently hold, or if you are watching from the sidelines, tell me what price you would be willing to enter at. Are you waiting for the full FDA clearance, or are you buying the appeal news? Returning to the analysis, we need to address the expectation versus reality of the business model. The expectation is that even if they get approval, selling a medical device is hard. You need sales teams, distribution, and insurance reimbursement codes. The reality, however, is that the telehealth infrastructure has already been built. The pandemic forced the medical industry to adopt remote monitoring at a pace nobody anticipated. Fidelity Investments analysts often talk about secular tailwinds, and the shift to hospital-at-home care is a massive one. HeartBeam doesn't necessarily need to build a massive sales force if they can partner with existing telehealth providers who are desperate for better data. A doctor doing a video visit with a patient complaining of chest pain is currently flying blind. If that patient had a HeartBeam device, the doctor could get a diagnostic quality reading instantly. That capability is the reality that could bridge the gap between a microcap valuation and a mid-cap valuation. However, We must remain grounded. The rise today is fantastic for bulls, but the stock is still trading under $1. This brings up the issue of Nasdaq compliance. To stay listed on the main exchange, a stock typically needs to maintain a bid price above $1. HeartBeam needs to sustain this momentum to regain that level naturally, or they might face the prospect of a reverse stock flip, which is often viewed negatively by the market. Traders using Robinhood stocks might not care as much about the nominal price, but institutional investors with strict mandates often cannot touch stocks under $5, let alone under $1. This creates a chicken and egg problem. Big money won't enter until the price is higher, but the price won't get higher without big money. The catalyst to break this cycle is the FDA. The company's decision to appeal the NSE letter is a bold move. It shows they believe the FDA's analysis was flawed or that the agency misunderstood the data. If the appeal is successful, it would be a major validation of management's competence, and we could see a rush of